You saw what happened. Trump quickly withdrew from his reciprocal tariffs to 10% when it looked like they were in trouble on a bond auction last week.
Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the Cash Flow Memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
All right. I think we're good to go.
Okay. We're going to dispense with Exhibit C, the oil price situation, with a resounding no change. There's way too much extra capacity, and sanctions on Russia and Iran are on hold for the moment. So oil has moved lower. If you turn to Exhibit B, we have the pricing from last Thursday, and you can see that the near month moved all the way down to $61, and the 26 price was all the way down to $59. That is going to continue to be the situation unless something else happens. The most likely something else would be sanctions on Iran, which I think are not likely while they continue to meet every Saturday in Oman, or sanctions on Russia. And Russia has certainly been slow to reduce activity in Ukraine, but I think the Trump administration wants to postpone working on sanctions to give Russia time to begin to cooperate. As far as natural gas prices goes, it's all the way down to $3.58. That number was in the fours. The 26 price is $4. That number was better part of $4.50. The overall supply and demand statistics look okay, but the tricky part of this is that supply number of 106. I mean, we're according to Platts, we're producing 106, and it's only April. So that's where the problem is. To the extent that a lower oil price causes less drilling in the Permian, you can see those top two paragraphs. The big pickup over the last few years has been the Permian. It's up 7 Bs a day. Some of that will level out, but I don't think Permian production of gas, which is associated gas with the oil, I don't think it'll go down. The increase may flatten out, because as you go deeper zones in the Permian, you find more gas. Exhibit A, we're kind of on hold now because the House and the Senate have both passed frameworks for a reconciliation bill, but then they went on Easter recess. When they come back, hopefully they complete that. The sooner the better, because what's needed after that is a budget proposal for the next fiscal year beginning October 1 from the administration, and then have all 12 committees start to function in the House and the Senate on their parts of the budget. In an ideal sense, since we're spending $6 trillion away from interest, in an ideal sense, that administrative budget would be something less than $5.5 trillion, maybe $5.25 trillion. That will require some surgery on the healthcare side, as well as in that all other, maybe even some reduction from the $900 billion range on defense. But, it's really necessary. A $2 trillion deficit is not sustainable. And maybe there'll be $200 or $300 billion of tariff revenue. But, we just have to be on our way down to getting the deficit 3% of GNP, which every time our Treasury Secretary speaks in public, he emphasizes that. And our GNP is just under 30 trillion, 3% is about $1 trillion, we're $2 trillion. Some significant chunk of that shrinkage has to come from spending. Jason, Mike, anything else on that?
No, I guess just maybe making up the revenue shortfall in tariffs is interesting. The thing I've been thinking about is how Trump's been able to convince us that a 10% tariff globally is an okay thing. Everyone's just talking about the ridiculous reciprocal tariffs at this point, and not that there's a 10% tariff. And then for perspective, I went and looked at what the 22 numbers were, and the U.S. had an average import tariff of 1.6%. Germany was kind of the same. Japan had tariffs on us at 3.2%. Same with UK. Basically the same with China. And India was the only one. They charged us 11%. So that was the only one, like even in the ballpark of the 10% that we're charging. So the fact that we're going to make up that much in tariffs and globally they've seemed to be okay with that number now is kind of astonishing to me.
I agree with Jason. That if you look at Exhibit A, that excise and others is the tariffs. It includes other things, I think, but it's been running around $250 billion. I don't think it's going to be a significant source of getting the gap to 3% of GNP. I think if Trump could start the year over, probably ought to leave the tariffs to the academics the few academics that believe in them. You know, I don't think it's helping too much now. The tricky part of it is that, and in terms from an investment point of view, the tricky part of it draws attention to things like bond auctions not working. And if we ever had a bond auction not work, that would be, well, you saw what happened. Trump quickly withdrew from his reciprocal tariffs to 10%, and we'll have everyone in when it looked like they were in trouble on a bond auction last week. So, you know, it's like the capital markets equivalent of a nuclear bomb. You know, you just can't have it. So I think the good news is, from an investor's point of view, is the market's pretty influential here. And I think the market generally does a good job of trying to discipline things. I think the best thing to do is to turn to page 1. And in the episode that didn't record, we were trying to figure out on a page-by-page basis where the impact of tariffs, where people would be hurt by tariffs. And we get on page 1, you get Apple. And in the first Trump administration, they got a complete exclusion. So it didn't hurt them much at all. But Mike, Jason, I mean, even though Apple is, gone down a lot, it's not something to take a new position in, I don't think, with the uncertainty. I just don't. Plus Jason's point that they can't, their Apple Intelligence, their AI, meaning Apple Intelligence, is just a complete bust. And it's just on the verge of being embarrassing, I think. Any comment there, Jason?
Yeah, and I think China's a big risk, not due to the tariffs, but just because the lack of Apple Intelligence, and then the sentiment of that nation towards the U.S. now, and will they really be buying Apple products when the local homegrown products? Huawei's doing a great job. Those are at par or maybe better in some circumstances than Apple's products.
Yeah, there's also a popularity thing with this too. You got to figure that if we do implement these tariffs on smartphones, there's more than 50% of the U.S. population uses Apple phones.
Right.
It'll probably be deemed a pretty unpopular one because especially for lower income, it's a higher percentage of your spending. So I don't know. It's not a great outlook for Apple.
So there's a lot to figure out for Apple. I think in my mind, the privacy is the big one. You don't want to be shipping AI control of all of your other apps on your phone, including your banking information, to an Apple cloud server somewhere else that will then have access to these components. So I think it has to be done on the device so that you're local to the apps that you have installed, and everything can happen encrypted without ever leaving. So without ever opening the door for vulnerabilities.
At the same time, OpenAI is talking about having that exact capability of being the login layer that you might use for other applications so that those applications work better for you. So there's a lot of things to be figured out specifically on this privacy and security side of things.
And OpenAI might get there first just because the public demands it, and Apple's now a year and a half behind. So they might have their way despite what Apple says. You know, if Android phones come out with this within this year, and then Apple says their products at least another year in the works, that's an upgrade cycle for mobile phones. So will people start shifting to Android then?
Microsoft Copilot, Mike, Jason, are they where do they stand in this contest?
They've had a look behind the curtains to pretty much the best AI lab, right, with their relationship with OpenAI. So I think they've come to the conclusion that they can, one, they don't want to fund the development of the models. So building really big clusters doesn't fit with their general line of business. Two, they can make money on it by just raising the price of Office 365 and including it with Office 365 as we have an entire global population of people that need to learn how to use AI, and it's not going to happen overnight for our customers. So they need to be in the game, but they don't need to be on the bleeding edge. That's kind of how I interpret the situation. So I think they're going to continue to invest in these data centers and AI and all that, but they're sort of distancing themselves from OpenAI.
How are you convince your complement of employees to use the Microsoft Office 360 Copilot when really what they want to use is the OpenAI systems?
Well, you force them, which is easier if you're a big Fortune 500 company. You have the devices locked down and there's no software that you can install without their control. For small and medium businesses, it's a little bit different. Obviously, you can work around that much easier. So we'll see. I mean, presumably they're still with Copilot offering the latest or near the latest model. I just think that the usage statistics for Microsoft 365 customers is so low that the cost to serve it they're not worried about it.
Right. Let's switch to page 3 in the video. Jason, they talk about losing $18 billion of sales and having a $6 billion inventory write-off. It's just the same old, and just much larger numbers in the chips business. Inventory write-offs or what's going on there?
That's the way I look at it, because this was kind of inevitable to happen. That the inventory write-offs the big thing, because they thought they would sell through this inventory of chips to China, and then as they stop producing the next generations, even the current generation, they can't sell into China. So as they produce new versions of the chip, China's no longer a market for those new versions. Like they're not selling Blackwells to the Chinese. So it was just kind of moving up the inevitable. And that's really the way I look at this, the new sanctions.
And then also you have Huawei actually producing an AI server that is comparable to the H20. So, it requires, maybe their yields aren't quite as good. Maybe they're still getting some of the chip produced at TSMC.
They are, yeah. A lot of, it's surprising the bill of materials in the Huawei chip is dependent on Japan, the US, European nations. TSMC produces it. So, yeah. Not completely homegrown.
Page 4, Netflix. Is Netflix completely insulated other than, economic conditions to tariffs, do you think?
Maybe not totally, because China did say something about how they weren't going to buy our movies. I don't think that affects Netflix as much as it affects Disney. I don't know. Jason, do you have a different view on that?
No, I don't see any, first order impacts to Netflix.
Also on page 4, Zuckerberg's testimony with the FTC for 2 days. Let's suppose the court decides they shouldn't have been able to buy WhatsApp and Instagram. What then? I mean, maybe that's a question for Mike, married to an attorney that specializes in litigation. What do you do?
Well, I think Meta's done a good job. Well, that acquisition, Instagram, they clearly saw that there was a threat that the next generation of users was not going to use Facebook, which would mean that Facebook would be essentially a fad that occurred over a period of time and ended. So the thought process is, if they could acquire Instagram, they would acquire the next generation of users. And if they integrate that into their big ads platform, then they never lose the users. They have a better product for their advertisers. And they've done a good job of wrapping all that together. To me, it's like, if they approved this merger a long time ago, then why are we relitigating the past? But I guess my takeaway is just that the suit doesn't make sense at all. Maybe it was a failure of the justice system in the first place, but the reality is Instagram was so small back then, nobody knew that it was going to be big.
Yeah, I don't think it was a dumb decision to let them acquire Instagram. Everyone thought it was a dumb acquisition. They paid $1 billion for a 50-person app that wasn't. They didn't even own the social picture sharing market at the time. And then I saw one thing where the FTC narrowed the scope of what they consider as Instagram, Facebook competitors down to basically just Snapchat. So it eliminated, Twitter and the other like text sharing platforms, which obviously compete for attention space on a mobile phone. So I don't see how the decision comes out negative for Meta, but I'm not the lawyer.
Yeah. Page 8, Walmart. How does Walmart compete with 4-hour delivery from Amazon? Or I guess the inverse of that is Amazon, everyone seems to want to own Amazon data center business, Amazon Web Services, but is the Amazon business, is it in retail, are you able to compete with Amazon with 4-hour delivery? And can you possibly replicate, or isn't it impossible from a commercial point of view to replicate 4-hour delivery?
Well, we know the cost to replicate 4-hour delivery is astronomical. And I don't think Walmart really has the balance sheet to be able to do it.
And they're trading at a pretty high valuation.
I don't know why, but my thought on how they compete is maybe they seed this really short delivery. They can't compete in the delivery infrastructure today, but they have, where Amazon has their big warehouses, Walmart has all these distributed warehouse being the stores all over every city. So when the day comes, maybe they need to partner with a Tesla or a Waymo, but there could be a specialty delivery vehicle that they could just be making runs from the store to everyone's house with autonomous delivery. So I think that's maybe the end around that they have available to them.
So does that justify the 48 times cash flow number?
No, I don't think so.
Speaking of Uber and DoorDash, that's page 20. These stocks are they're doing okay. I mean, I would say they're kind of fairly immune from tariffs, and maybe beneficiaries of, robo-taxi delivery for DoorDash. Uber, I guess, has embraced Waymo, or is collaborating with Waymo. So the question becomes, and this gets back to a Tesla issue on page 1, if full self-driving is, in effect, working and fully developed, or what Musk say, we're finished, or kind of, or we're, he didn't even say we're close to finished. I think he said we've done it. How, if you're Uber, how do you deal with that? Or if you're Tesla, how do you compete with Uber? I know Jason is a big bull on this. Jason believes that there'll be robo-taxis all over the landscape 5 years from now. Or am I misquoting you, Jason?
I'll take it, though. I think Uber is going to be the network. Tesla says they want to operate the network. I think in the short term, Uber has the advantage by having a hybrid network where, at rush hour, the demand on the system surges, and Uber will be able to fill it with human drivers. Maybe someone drives someone else home, essentially carpooling, and gets paid for that. So I think to accommodate those kind of surges in demand, they have the advantage there until Tesla, they'll have to produce enough robo-taxis and saturate a market so they can fulfill all the demand. But there's always going to be some of it being pushed to Uber in the near term, I think, while they build that out.
Right. And the other question is, so I guess one way to think about full self-driving is there's a certain amount of capital investment and technology investment and compute investment you have to make in order to, and data investment. So you got to make these 4 or 5 investments and put it all together and come up with a good enough self-driving model. And we've talked here about, what is good enough. But I think Waymo's getting there. We think Tesla's there. And not far behind it will be all the individual automakers that are adopting the NVIDIA Drive program. And with that, they're going to have to invest in it themselves, but at some point, the technology will be there. So for Uber, I think they, maybe they bridge with Waymo for a while, and eventually some of the homegrown manufacturers have a product that's, again, reaches the quality and performance and whatnot that's good enough, and maybe that's where they get their next set. I think Uber, if you look at Uber's network effects, it's the supply seems to be more important than the demand, because demand is flighty. The consumer of Uber or Lyft will very quickly look at the prices for each one and choose the one that's cheaper. There's not a lot of brand loyalty or differentiation. I think as we get into full self-driving, maybe there'll be more differentiation. So we'll see.
Uber's pretty healthy financially. I mean, its debt is down to practically nothing, and it has $6 billion of free cash flow. So they're going into this move from drivers to vehicles with FSD and in pretty good financial shape.
Okay, let's take a quick break for a message from Oakcliff Sailing.
Hello, we're reporting on Wednesday from Oakcliff. Luke just hit over there. He's going into the greenhouse to repair a Match 40. They got crushed in the match racing. Fixing the Par 40 red cover. It's chilly here. We've got the protector going, the high foil getting ready to do Sail GP. The kids from University of New Hampshire came and got Par 40 blue ready to go in the water, and the mast rigged because they're going to sail it for AYC spring. Speaking of spring, it's spring break, so we have Bill, the spring break elder statesman, helping the youngins fix the engine. Ethan, what are you guys doing here?
We just replaced the neutral safety switch on the starboard engine. And we're cleaning them, replacing the zincs, engine oil, lower gear oil, fuel filters, and cleaning the rest of the metal on the boat and everything else.
Are you guys going to be able to repeat that? You're learning. Okay. And then the only other thing is, and hopefully you figured it out, is that Charlie Enright is the new CEO of U.S. Sailing, and he is an Oakcliff grad. So we hope you have a good spring day, and I'm going to get back to my computer to work fast. And also, don't forget, you can become a supporter and come sailing with us this summer. Talk soon.
And now back to the show.
Getting near the end here, Jason and Mike, any healthcare news for Vertex Pharmaceutical or Lantheus or Harrow or any of the other healthcare companies you spend time on?
Some news out of Eli Lilly was they released some results from a phase 2 study studying a drug to treat levels of LP little a cholesterol. So it's a type of cholesterol that most people don't know of, because I think from my understanding, mainly because we didn't have a way to affect any change on that, so that we didn't test for it. Why this is important is Lilly's drug showed that for a year, which is the duration they looked at patients in the study, it held LP little a levels down by 90%. And why this is important is that is what binds with the LDL cholesterol to create clots. So encouraging that there could be new ways to treat cardiovascular disease. So it'll be exciting to see how the phase 3 progresses there. That's all I have really on company specific news. Some interesting stuff going on maybe food supply regulation under the FDA not even under the FDA. There's a handful of states, California, Texas, Arizona, and West Virginia, I believe, that are enacting at the state level regulations on food additives, and mostly on the colorings, the dyes used in food. So progress there. I think it's about time we've kind of looked at what we allow in our food supply. We kind of have a Wild West approach in the U.S. where if we allow it until it's proven to not be safe, where the rest of the world, if you want to put a chemical into the food, you have to prove it's safe for ingestion. So I think if enough states, obviously the new administration wants this to occur, but if enough states put momentum behind it, and it's blue states, it's red states, it'll force a national level kind of change to the regulation there.
Just in the closing minutes, pages 9, 10, 11, and 12, which are the energy pages, I updated the values over the weekend. I still got to get to the 10Ks, but there won't be too much change in the free cash flow or the trends in free cash flow as they get updated for the year end. We talked earlier in the call about companies that are immune from tariff activity. So starting on page 9, just to close us out here, I don't think Exxon, Chevron, Conoco, or Cheniere are going to be too impacted by the price of oil. Obviously, their cash flow will be lower. Remember, gas averaged $2.40 last year, and this year it looks like it's going to be, in the $3.50, $3.60 range. So it'll be a pickup in gas to make up for the lower oil price. I think oil averaged $73 last year, and based on the current quote and the months we've already had, you're probably talking about a $62 or $63 average. So that's $10 down. These companies will reduce their capex. You can already see they'll drop rigs, they'll drop completion crews. So they'll be pretty protective of that free cash flow. I left out Oxy in saying I don't see too much impact from lower oil prices, because if you look at the debt levels in these companies, Oxy has relatively more debt. Cheniere is LNG export, and that business is pretty healthy. The risk there, I think, is if there really was an agreement with Russia and the Ukraine, and the Germans or the rest of Europe could start using Russian gas again, that would be less market for LNG. But I don't think, it might mean LNG prices are $10 versus $12. it takes you about $3 to make the LNG, and it takes you about $1 to transport it. So $10 less 4 is still about $6. So I mean, I think there's plenty of margin. On page 10, which is the midstream companies, none of these companies had any free growth, and that's true for the page 9 companies. No one's having any free growth in cash flow. But again, these companies will adjust their capital spending. I don't see in the case of the larger companies, they're trading at, integrated companies, they're trading 8 or 9% free cash yields. You get to the midstream companies, and they're generally lower by a couple of percentage points. So they may not be terrific investments, but if you're in them, I don't see that lower oil prices are something to be too concerned about. As you move to the upstream companies, page 11, EOG and Magnolia being favorites of ours because their CapEx, they consistently have their CapEx be half of their cash flow. Once again, oil will be down, gas will be up. They'll adjust their capital spending. Once again, you look down, there's been no free cash flow growth except Permian Resources, and that pretty much was an acquisition. Again, they're actually at higher free cash flow yields than the Exxons and Chevrons. So not bad investments, not a bad place to have as part of your portfolio. Natural gas stocks, which is page 12, these companies are trading at lower free cash yields, but remember, free cash flow yield is based on free cash flow based on lower gas prices last year. So I would say if you adjusted for this year's gas prices versus last year's gas prices, they're probably going to come back on a free cash yield basis to 9 or 10% or something like that. Once again, not much free cash growth. And so not a bad sector of the economy, but one that is not a, if you hold positions, I don't think you move out of them. If you're looking to add to a position, it might, with all the uncertainty on the price of oil, it might be better to wait. I'm just going to cover page 13 because these companies just reported their earnings for the first quarter. This is JP Morgan, Morgan Stanley, Goldman Sachs, and Interactive, all very strong first quarters. Seems kind of incredible that with all the trading revenues in these firms were up 20-30%, but I guess what it shows is that the trading revenues benefit from volatility, and they all have free cash flow. JP Morgan is actually fairly large. I mean, $67 billion of free cash flow puts it right up there with some of the Apples and Microsofts and whatnot. These companies are trading on the cheap side. I mean, they're in the 10% free cash yield. What they're going to do, I think, with reduced regulation from the Trump administration, they're going to be more active buying in their stock. If you think about it, the free cash flow that comes out of these companies, in other words, the amount that could be dividend, really belongs to you. I think they're all well enough capitalized so that they don't have to retain that free cash flow. There always is a risk. These are large, pretty complex organizations that if you had credit problems, such as you had in 08 or 09, they're not exempt. I mean, geez, Morgan Stanley in 08 almost had to file reorganization. They got rescued by Mitsubishi. Goldman Sachs was in trouble. JP Morgan kind of skated through it. So there is some downside risk if with really creative, really disruptive credit market conditions like we had with mortgage bonds. But at least for the moment, while there's been way too much private credit done, and oftentimes by the Apollos of this world, so the banks participate, but a lot of it is done in the private market, and probably too much money is chasing too few deals there. So in a recession, you could possibly expect some problems there. But for the moment, these companies seem fairly valued, and if you can have a 10% free cash yield and reduce your stock 4 or 5% a year, you add the two, that gets to a 15% return. So it's something to think about. Anything else, Mike or Jason?
Well, that point on the more credit is moved out of the banks, but more banks are actually providing credit to the Apollos of the world. So it's still there, but maybe it's a little bit better distributed than it used to be.
Yeah. One of the things that happens, and happened last week, is hedge funds with very large leverage positions in treasury bonds are probably more or less backstopped by the very big banks. Mm-hmm. So the discipline of when you're told you've got to liquidate your positions, that call is probably made by the JP Morgan or other large bank credit departments. Mm-hmm. And so as a stockholder in those companies, you're very dependent on that leadership, that bank leadership, and that credit review for all the positions they have out there doing their job. But so far, so good. With that, I think we've gotten through our 30 minutes. Thanks for everyone's attention, and be well and stay healthy. And we'll be back with you 7 days from now. Take care, everyone.
The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the host nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.